Well, Nifty has touched 20,000 and it's a big moment. But it's a very proud moment that for the first time you could actually say that in Indian markets, the wealth this time or the effects of wealth creation are being enjoyed by Indian investors. There used to be a time when Indian investors would shy away, Indian companies were delivering and growing, and for institutional investors, they were taking a leap of faith. But in the last couple of years, courtesy SIPs, PMS schemes, the belief in India, I guess the Indian market now has become vibrant, and the wealth creation is something which is benefiting crores and crores of Indians, whether it's via direct equity, mutual funds or PMS schemes. But when you reach a landmark like 20,000 on the Nifty, it's time to celebrate. It's time to look back, it's time to look forward, and it's time to take a fresh guard. You know, every time a batsman hits a century, you just look up, thank God, take a fresh guard, and perhaps prepare for the double century. So since cricket season is round the corner, let's connect cricket and markets on this edition of Markets and More with Sunil Singhania. Mr. Singhania, good morning. Thank you for joining us. So 20,000 on the ticker. What does that mean for a long-term investor?
Good morning, Nikunj. Thanks for having me. I think all milestones are good, and positive milestones are always very pleasurable. So I think it's a good milestone. 20,000 is a great number. Specifically looking at the fact that we started, Nifty maybe 95 at 1,000 odd levels, and I think from there we have seen the country evolve, the country grow, and particularly I think the last 3-4 years, despite all these headwinds which we have had, including the Russia-Ukraine conflict, COVID, and so many changes in our systems, including GST, DeMon, and so on and so forth, I think the country is firmly, on track to continue its growth rate, being one of the fastest growing economies in the world. And for a change, I think this milestone does not sort of scare you. I think this is a milestone which is backed by fundamentals, which is backed by optimism that this growth rate is going to continue. And therefore, I think it gives confidence that this is just one of the milestones. There are many more which we need to conquer as we move ahead.
Right. But if one looks at the tone and the tonality of the market, Nifty may have done precious little this year in terms of absolute return. But there is a giant rally in small cap stocks. There is a jumbo move in SME stocks. And there is a smart comeback in some of the mid-cap stocks. Do you think somewhere we need to be worried about the sheer level of participation in the mid and the small cap stocks?
No, I think you're right. But you have to remember a few things. One is there was a little bit of underperformance before this rally started, particularly in the smaller stocks. And second is, I think the broader participation in the markets have been pretty good. And when that happens and when there is optimism and news flow, it is typically the smaller stocks which end up doing much better than the larger stocks. And I think it's a cycle, it's always possible that now year on, maybe the large caps might perform better, but it's a cycle. And it does lead to some concerns, particularly for value conscious and, long-term investors like us. When you look at themes and momentum and stories, driving stock prices than near-term fundamentals. So I think it is a time to be optimistic, but at the same time, you have to be extremely cautious, because you don't want a scenario where in a vibrant market you end up getting into stocks where you don't see their prices again for the next 3-4 years, and the market keeps on doing well, but the portfolio suffers. So I think one has to be definitely optimistic, because there is still a lot of room ahead for the economy in the markets, but extremely, extremely cautious of not getting sucked into this FOMO kind of a situation.
Okay. Do you think a FOMO is at play when it comes to some of the exciting and popular themes, let's say it's defense or shipbuilding, or for that matter, railways?
No, there is, so someone was asking me, when is the time to get down? And I replied that, we missed this train. We have not got into it. So where is the question of getting down? So I think in some of these companies, there is a lot of fundamentals which are backing the optimism. I think the government has gone on a front foot in terms of Make in India as far as defense is concerned, youth spending as far as railway is concerned. The recent announced, corridor from India to Europe via the Middle East is again something which is lending a lot of optimism. But at the same time, I think these are long gestation programs, and it will take a few years for them to get off the ground. We are already building in maybe 5 years forward in the prices at this point of time. So selectively, I would definitely urge that this is not the time to just blindly get into something because there's a name defense or a railways or a shipbuilding or an EMS attached to it. Be discreet. There is, as I said, a lot of opportunity in these sectors, but now one has to be careful in terms of the stocks which you invest in, even within these sectors.
So let me divide the market the way you look at things. Cheap and attractive, good but expensive, euphoric and should be avoided.
So not too many stocks are cheap, frankly. I would go the second option, where it is decent, it is showing growth. But Nikunj, I think the overall market will fall in one of these three buckets. It's not that the overall market would be in one bucket. So we discussed about euphoric. Definitely it is there. There is definitely opportunities coming in as far as the economy is concerned. If you see the June quarter numbers, maybe after 6-8 quarters, it was a quarter where earnings were upgraded. We are also looking at a scenario where 16-18% growth in profit for the next 2 years looks possible. And if you look at that, I think you're looking at EPS somewhere just over 1100 as far as Nifty is concerned. And that makes the markets even at 20,000 somewhere in the 18 PE odd levels as far as Nifty is concerned on an FY25 basis. So it's not cheap, but it's like only 8-9% higher than the 10-year average. So I would say the middle option which you said that it's good, not very cheap, not very expensive is how you can describe the overall situation as far as India is concerned.
Let me divide the market in time frame, something which you've always looked at. You've said that, look, while 90% of Indians may have a time frame of less than 1 year, we have a time frame which could be anywhere between 1 to 3 years and 5 years plus. To your mind, which end of the market now is looking attractive if you have a 1 to 3 year time frame and for someone who has the patience to wait for 5 year plus?
Nikunj, the good thing about the Indian economy and therefore the Indian market is that we are very diversified. We have presence across sectors. So whether it is IT, pharma, cement, manufacturing, engineering, across, we have financial services, obviously. We have presence across sectors. And there are so many listed companies and there are so many new businesses which are getting listed. So I think to that extent, India is an investor's, I would say, dream where, you have presence across sectors, across companies, very, very strong entrepreneurs and so on and so forth. As far as the potential is concerned, I think India did very well as far as services is concerned. As far as knowledge-based sectors is concerned, which would be pharma and to some extent even chemicals. But now with this recent thrust of Make in India, import substitution, export focus, a lot of these manufacturing industries are also gaining a lot of credence, And particularly with this China plus one and now Europe also becoming a difficult geography to manufacture, I think those opportunities are also opening up as far as India is concerned. So if you look at 3-5 years and ahead, we have like almost all the sectors looking very exciting. From a 1 to 3 years perspective, I would say banks have done very well. June quarter, the earnings upgrade was largely because of the phenomenal results with the banking and the financial sector reported. However, that has been the sector which has lagged the most in terms of price performance. Maybe it is because of oil prices inching up a little bit and therefore inflation fears coming back. Maybe, there is a little bit of compression as far as NIMs is concerned. However, given the fact that if we believe India is going to grow, both government capex, private capex is going to be there. Credit growth is going to be strong. There is hardly any, non-performing assets left in the balance sheet of banks and financial services. So I would say from a 1-3 years perspective, financials obviously look very, very good. And then there are obvious names which are there. So manufacturing and all the buzzing stocks, defense, railways and all are also looking interesting. But the only thing is please be a little bit discreet. Just because of the sector, just don't get carried away. One also has to see the valuation. So I would say in the near term, these would be the sectors. I personally believe that the second half of the current financial year, starting from now, because the festive season has got deferred, the wedding season has got deferred by a month, should be pretty good. There is some concern about the rains playing a little bit of traunt, but it is expected that in the next 1 week, 2 weeks, that also should revive. Hopefully, we will not have a bad monsoon. We'll have an average to normal monsoon, and I think given that the festive season and the wedding season has got deferred, the second half of financial year 24 should be pretty good, even from the consumption perspective. So I would say from a 1-3 years perspective, even consumption looks pretty exciting.
If I look at your declared portfolio, what is available in the public domain and part of your newsletters, you got a lot of metal names there, especially Jindal Stainless as one of your top holdings. Now, this is very unusual because at a time when China is not coming back, one metal name is one of your top holdings. Are you bullish on the global economic turnaround? Are you bullish on the global metal demand? Are you bullish on the China recovery?
I think we have been extremely positive, particularly on the steel cycle and also within steel, specialized steel. In fact, because of our risk measures, we don't go beyond 8 to 10% as far as deep cyclicals are concerned, and that's why we restricted our exposure to deep cyclicals to 8 to 10%. But our view is that over the last 2-3 years, Indian steel companies in particular have, repaired their balance sheets phenomenally. The other thing is domestic demand for steel is very, very strong. Costs are pretty now in control. We have a scenario where capex on the government side as well as on the private sector is looking on an uptick. And if you look at railways and all the other things, it's all going to consume steel. Also, from an export perspective, yes, things are not that good, but we expect that with this a little bit of anti-China, sentiment, and also possibility of some revival as far as global economy is concerned, there will be export opportunities opening up also. And China has been trying to do its bit to ensure that growth rates revive there also. So in a scenario where China is not growing, Indian steel companies, particularly the specialized steel companies, have been doing pretty good. And if there is some tailwind coming in from global side, I think we would have a decent next 2-3 years. So that has been one of the reasons why we have been quite optimistic on that segment.
Since you mentioned banks, I want to go back to banks now. And within banks, it's large cap banks which are underperforming, PSU banks which are underperforming. This year, markets have made a new high, but banks have not made a new all-time high. Is this only because of the excesses in terms of positioning which had got built up and they underperformed?
Nikunj, cycles, particularly in the markets, have become shorter. Sectors rotation is like crazy. You had pharma doing its bit, then you had IT, despite all its negatives, do very, very well, and then you had manufacturing, and then now all the infra-related companies. I think banks, you're right, have not participated. And I mentioned earlier, it's been a combination of fear of inflation being a little sticky, and therefore, at least globally, and particularly in the US, interest rate cycles still have not, people don't have the confidence that it has peaked. And that is one of the reasons why banks have not performed. But I would be in that camp which would say that in the next 6 months, banks should outperform the Nifty. And particularly, everyone is becoming so excited about the public sector companies. I would say public sector banks have underperformed big time. And a lot of these banks are now trading at like P's of anywhere between 4 to 6 times. So maybe there is a decent enough opportunity there from a 6-month to 1 year perspective.
Historically, Mr. Singhania, markets have always rallied in the run-up to the election. At least the last 3 election cycles have indicated the same. Do you think this year it could be no different, that market actually could see a run-up in the run-up to the election cycle?
Nikunj, frankly, what you say might be right, but I would dissuade investors from trying to just use that as an opportunity to invest and trade out. I think I would say that at these levels, you have to be an investor only if you believe that India will continue to grow from a 3-5 years perspective. Playing the market from a 3-6 month perspective might not be a great experience. Renewed volatility is going to be the order of the day. There are going to be swings up and down, and therefore, only if you have a view that India is going to be maybe a $7 trillion economy in the next 6-8 years, that can be the only reason why you would be investing in the equity markets at this point of time.
You have followed a template of 15, 15, 15, return ratio 15, growth 15%, and P multiple of less than 15. Is that template still at play, or the market conditions are forcing you to change that template?
No, it's becoming difficult, Nikunj, for sure. I think 15% ROE is still possible, 15% profit growth is still possible, less than 15 P is becoming a challenge. But I think at the portfolio level, our all-cap portfolio is still at around 15.5 times P 1 year forward. And the mid and small cap portfolio, which is the emerging opportunities, is still around 14 times 1 year forward. And that is largely because, we are quite diversified in our approach. We have some metal stocks also where the Ps are lower. As I said, we have some banks and public sector banks, which again bring the overall P multiple of the portfolio to reasonable sort of valuation. So far it's been pretty good. But having said that, I would say that investing in these markets is very tough, particularly because the impact cost is pretty high, and liquidity is a challenge. There are too many buyers, and therefore, from our perspective, we have been very slow in deploying fresh funds.
Mr. Singhania, a lot of new sectors of late have got created, starting from drone to even specialized software companies which are in SaaS or which are in product development. Anything which is catching your attention, which could be the next theme in making, whether from the IPO market or from the secondary market?
I think the only theme we follow is that whether the company can double profits in 4 to 5 years. And a lot of these themes are interesting and exciting, but the valuation at which the IPOs are coming and the stocks are getting listed is something which at least conservative investors like us cannot comprehend. Yes, drones is going to be a big thing, but most drone companies in India are pure assemblers. You can create a drone manufacturing facility in 5,000 square feet, because it's predominantly assembling. And same is the case with so many other sectors. So I think, yes, sectors are interesting, exciting. Presentations made by the companies are even more exciting. You have all sorts of terminology which at least maybe old people like us don't understand. So I will again urge, that themes are good, but ultimately the theme which plays for the long term in the equity markets is profits, profits and profits of the companies where you are investing.
But are we going to that phase of the market where profits would be visible, but it's not the profits, but it's the prices, which in a sense could be the restrictive factor? So the economy will grow, profits will grow, and stock prices may not grow because the run-up has already been extraordinary.
No, that is where I'm saying, Nikunj, that if you are paying too much of a price upfront, if you're buying something so expensive that even after profit growth, it is going to be expensive. What you're saying is absolutely right. And that is exactly what I'm trying to caution, that themes are good, but, what you're paying today should be more than paid back to you by way of future profitability. And I think that is what the focus of investors should be.
When I was preparing for the interview, I stumbled on some of your old
And we have seen in so many companies, there was this concept of, buy at any price. I think those stocks have not performed. Because these are great companies, great, pedigree, but you had already upfronted paid such a high price that despite them being great companies, they have not been great stocks.
I just wanted to refer to this point further because I've stumbled on some of our old notes when I was preparing for the show. You've done some work where when price multiples go north of 60, 70 times, the future return gets compromised. Do you think that really could be at play in a lot of stocks now where P multiples have gone to 100 plus? I mean, a company like DMart or a Trent or an Asian Paints or Pidilite, these are P multiples which are north of 50, 60, even 100 times now.
So, ultimately growth has to justify what multiple you're paying, So if a company is growing at 30-40%, maybe you can justify 40-50p multiple. But if a company is growing at like 10%, you can't justify such high P multiples, because then the P multiples will have to be that high all its life. And I always say this, that even in US, there will be not too many companies which have traded a P multiple of more than 50 times for more than 5 years. So I think somewhere, Nikunj, this is tried and tested. We have world stock market history of almost 400 years. And history does give us some learnings. Yes, every time is a new time, and there are new learnings. But ultimately, I think it's always better to cry without investing than cry after investing.
Such a good thing to say. Couple of closing questions. I'd like to draw your attention to the SME space. And suddenly in the SME space, I get a sense that there is more like a FOMO. Forget FOMO, there's more like a madness. SME companies have started commanding P multiples of 100 plus and market caps which are now nearing 1,000 crore plus. Do you think there is a mania in the SME space and one should be careful?
There's absolutely no doubt. So, this is a space which is interesting and exciting, and I think it's good because small entrepreneurs are getting an opportunity to raise capital and grow. I think it's a great step from the government, from the regulators, to encourage it's like between the startup and the listed space. But I think what is happening of late has been not exactly, I would say, based on fundamentals. What you're saying is absolutely right. And I would say that this is a space which is good if you're able to do your due diligence properly. The only challenge is that because it's SME, it's low touch. And therefore the regulators, are, I would say the regulations are less stringent compared to the main board listing. And therefore the investors have to be all the more careful about what they are getting into. But it's mixed, there are some good companies which are coming up, some really good entrepreneurs. We are in one of our smaller fund avid investors. The experience has been pretty decent.
Historically, if one looks at how Sunil Singhania has invested, he's bought into infra stocks, he's bought into construction companies. Has that cycle started again? Road, real estate, basically the construction companies, because that's where I guess a lot of action has started again.
So, to build infrastructure, you need EPC guys, and obviously the order books for a lot of these guys have been at record highs. The good thing is that after what we saw in between 2006 to maybe 2015, where some of these companies over-leveraged themselves, some were not very clean, there was a massive, I would say, unpleasantness from both lenders as well as from equity investors. I think now the companies which have survived have proven that they are the ones who are cleaner, who have a better balance sheet in terms of their debt equity ratios, and who are focused